how likely, what's the probability that when you see a structure like this, that it does break through ultimately?
Yeah, no, that's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure, not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right. Okay. But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going. Okay.
Okay. So based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's inevitable. Okay.
Yeah, and it will be soon because this thing is ripe as a beast.
Okay.
And we know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning.
What are investors missing right now, and what do you expect for the miners over the next 3 to 6 plus months?
Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5-6 months ago? No, actually back about in June, okay? It was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40 something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled plus in a matter of handful of months. And I can't have a sharp pullback? Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, we didn't even get to it this week when we pulled back into the high 60s. That's down in the lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay. You won't be able to catch the big move. We've had, silver dropped hard 1 week last week, okay, and some follow through this week. So prices only dropped for 1 week. But when we run weekly momentum, which is also in this report, you made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. What I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down on momentum, and you got into what we call an oversold situation with only that one bad week, creating an oversold situation. Whenever we've seen that occur over the last year, there were like 3 or 4 instances of where similar action occurred. It was over. I don't care how bad that week looked. You didn't follow through in a sustained way after that. You started the turn. So even though it looked ugly, especially to price chart watchers, momentum says, no, you're through. You're exhausted on the downside. And I think that's where we are. And that's the nature of the sell-off you're going to be seeing in the future. It's not this 1 year wide range that silver had between May of last year and June of this year, where you could just draw a line through about $32 and it'd be above or below it for a whole year. Or gold, like 5 months, April through May, June, July, August. Sideways recently. That's not going to happen anymore. We're now in an accelerated phase. And in particular, when this particular spread chart breaks out, it not only says is gold going to beat the S&P, but it means the money flow is really just beginning out of stocks into gold. which means what? The verticality we've seen in price lately in gold is just the beginning of that sort of verticality.
Where are we in your analysis in this bull cycle when you consider that the typical precious metals bull cycle does not last for just a year or two?
What might happen in the next year or two might be awesome, though. I think we're going to go into a new reality. Go to the next page, if you would. This is another spread that we're watching we think is enormously important. This only goes back to 2020. If you recall, in early that year, silver about doubled in price, went from like $15 to 30 in 6 months. A lot more than gold went up. So this spread went from 0.9% to 1.5%, which is, huge move. Silver doubled, gold went up like 40% or so during that surge. And then what happened after 2020, price-wise, late 2020, silver had bumped 30 area, and it went sideways to down while gold went sideways, okay? So on a relative basis, silver, that black line there, the black zigzag, is the price of silver divided into a price of gold, ounce per ounce. And silver went from 1.5% of the price of gold down toward 1% of the price of gold. So it's been an underperformer for all those years, though it's been going up in price, admittedly. Now, in the last handful of months, you can see that spread has shot up again, the top chart now. And there's a black line, a downtrend, that we bumped. And this month, we're backing off from it. So we've got a 3-point trend line there to focus on going forward. But we also have the green line. What does that say? That's a level where since 2022, silver has hit 1.31% of gold, 1.31% of gold. It's set a dual top there. If you go through that, it's called a triple top breakout. And we think that's about to happen. When we run, and now I'll tell you why this is important in a minute. When we run the momentum of that spread, which is the chart at the bottom, where we measure the spread in relation to its 10-month average, you have similar looking picture, except that the momentum has already broken out over its downtrend line, and it's bumping the horizontal structure, whereas the spread is not. In other words, momentum is ahead of the spread. It's closer to a full breakout than the spread is. If that momentum breaks out, and it doesn't take much to do it between now and Friday, for example, end of the month.
When you've spent decades staring at price charts, one of the hardest lessons to internalize is that clarity itself is a signal. Most people think it's just data. It's not. It's psychology. When you see a structure so clean, so obvious that it smacks you in the face, it's not there to tease you. It's there to tell you something big is about to happen. And I'm not talking about price charts here. Those are the bait. Price charts are for the tourists. They're what CNBC shows between commercials. The real story is always hiding in the spreads and the momentum work. Those are the X-rays beneath the surface. That's why I've been so fascinated by this gold versus S&P spread we've been tracking. And it's not just a ratio, it's a shift in the financial weather system. For months, it's been building a base so symmetrical, it almost looks intentional. And let me tell you something. Markets don't build clean bases like that just to collapse. That's not how energy works. When you build something this clear, you're not waving goodbye to it. You're coiling the spring for what comes next. Right now, that structure is loaded. It's what I call ripe as a beast. Whether it breaks this month or next month almost doesn't matter. It's inevitable. Because when you've seen this movie as many times as I have, you know how it ends. These patterns don't die quietly. They explode. What makes this one so extraordinary is how invisible it's been to the mainstream. Nobody's talking about it. I haven't seen one financial publication, not one major outlet, even acknowledge this spread structure. CNBC, Bloomberg, Fox Business, they all focus on nominal price because that's what gets clicks. They don't look at relative strength or spread momentum because that requires context, patience, and, dare I say, a functioning attention span. But that's where the real message lives. The spread between gold and the S&P isn't just data, it's a referendum on trust. It's the market's way of voting on which asset represents real value and which represents a bubble built on credit. And that vote is shifting fast. We're now at the stage where gold's relative performance against equities is telling us this isn't a fad rally, it's a migration. Money is leaving the stock market, the last bubble standing, and it's moving into the one thing that can survive what's coming, tangible value. Now here's where it gets even more interesting. The spread isn't just breaking out, it's confirming something we've seen before every major macro reset in history. When gold begins to outperform the S&P in a sustained way, that's not a rotation. That's a regime change. It's a signal that capital is beginning to abandon risk for reality. And when that breakout becomes official, you can expect a sequence of headlines. First, you'll see the denial, just a correction. Then you'll see the rationalization, rotation into defensive assets. And finally, you'll see the panic. Why is the stock market collapsing while gold surges? By that point, it'll be too late for most people. So when I say the structure is inevitable, I mean it's the starting gate to a whole new phase. We're not talking about a few months of bullish price action. We're talking about a multi-year revaluation. Now let's talk about the miners, because this is where leverage meets opportunity. I've said for a while that if you think gold's doing well, just wait until you see what the miners do once this breakout gets traction. Look at GDX, for instance. Back in 2011, it peaked in the 60s. A few months ago, it was trading in the low 40s, barely above half that old high, even as gold itself was well above its 2011 level. Then in a matter of months, GDX doubled, 40 to 85. You think that's froth? Number. That's catch-up. That's the market realizing how undervalued the mining sector had become relative to its own product. And sure, we had a pullback, $10, $15 off the top. You'd think it was the end of the world from the way some people reacted. But guess what? The structure didn't break, it just caught its breath. The miners always exaggerate the moves of gold, both up and down. That's their nature. They're the high beta cousin of the metal itself. So when you see a sharp pullback in the miners after a vertical move, that's not a reversal. That's a rest stop. You doubled in half a year. You're allowed to have a bad week. If you can't stomach that, you shouldn't be in this space. Because the people who bail out after a bad week will never be around to catch the big move that follows.
Ignore the sell-offs just look at a silly price chart of gold or silver. Just for example, back in, remember, silver was capped off at $35 October last year and March of this year, and was in a one-year sideways range. And when it came back up through 34, we said, watch out, this time it's going to blow, but it's going to get more vertical. It's been a 50% increase in price since then, and 8 weeks prior to last week now, 8 weeks of higher highs, higher lows, 8 weeks in a row. I mean, that's highly unusual. Can't it have a break where it takes out a prior week's low? Is that really a disaster? Now, gold, which is interesting, last week, when silver took out the prior week's low, it refused to take out its prior week's low, so it had 9 weeks of higher lows. Today, finally took out a prior week's low. And it's the end of the world? Let it breathe, okay? It's an opportunity to buy if you're not already in. I don't see protracted congestion, which is what we had April, May, June, July. You know, in 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week, okay? But right now, we're not at that point. The action last week, to a large extent, put us in a position where, in our weekend report, we suggested that was probably mostly it, okay? Now, the only problem was gold hadn't taken out a prior week's low, and so we finally did. That means we got under 4,000. Okay, it's back above there now. I think the cleansing we just had is probably about exhausted, and that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so. Okay? And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. We're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those.
Keep talking and I'll look to that.
Okay. On page 1, we had a technical situation. Yeah, here we go. Spread chart. There you go. Now, what this chart shows, if you can get even closer to it, it'd be good. If not, what it shows is gold going back to about 2013, plotted in its percent relationship to The S&P 500. Okay. The biggest bull market out there right now. U.S. market is the bubble. No other market in the world matches what we've done. Okay. Since 2009 low. But anyway, gold is in decline since its 2011 peak in price, but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low, under 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months.
Let's zoom out now and talk about what this means in the bigger picture. Because we're not just talking about a price pattern, we're talking about a phase transition. When you see a structure this symmetrical, when every test of resistance and support happens at nearly identical levels, it's not randomness. It's mass psychology manifesting in geometry. The market has collectively agreed on the battle lines. That's why I said earlier, you don't build something this clear just to abandon it. You build it to launch from it. Now, when that launch happens, and it will, it's going to do two things simultaneously. First, it'll confirm that gold's decade-long underperformance versus equities is over. Second, it'll confirm that the bull market in metals is still in its infancy. And if you think that's an exaggeration, look back at history. Every major precious metals bull cycle begins exactly this way, with a slow, frustrating buildup that suddenly gives way to vertical movement. Think 1976 to 1980. Gold quadrupled. Silver went from $4 to $50. Then think 2001 to 2011. Another decade-long run where gold went from $250 to over $1,900. Those weren't accidents. They were the inevitable result of a system rebalancing itself after a decade of credit abuse. We're there again. But this time, the setup is bigger. Global debt is exponentially larger. The leverage is systemic, not cyclical. Central banks are no longer pretending to tighten. They're buying gold at record pace. And for the first time in history, private investors can see it all in real time. The fog is gone. The breakout we're talking about isn't just a line on a chart. It's the reflection of an energy shift across the global financial ecosystem. Now let's bring silver back into this because it's about to have its moment. We've been watching a key ratio, silver divided by gold, ounce for ounce. Historically, when that ratio rises, meaning silver outperforms gold, it signals a phase where risk appetite is returning within the precious metals complex. It's like the metal market's version of small caps outperforming large caps. In early 2020, silver doubled in 6 months, from $15 to $30, while gold rose about 40%. That pushed the ratio from 0.9% to 1.5%. Then for nearly 3 years, silver lagged again, sliding back toward 1%. It was the metal everyone loved to hate. But lately that ratio has been rising again. Fast. We're bumping right up against a 3-point downtrend line that dates back to 2020. If we break through that resistance, it's going to be explosive. The technical term is a triple top breakout, but the human term is holy smokes. Because every time in history that silver has broken a multi-year relative resistance like this, the subsequent move has been vertical. And here's where it gets spicy. Momentum is already ahead of price. If you measure that silver/gold spread against its 10-month average, momentum has already broken through its own downtrend. It's leading the price. That's rare. Usually momentum lags. Price breaks first, momentum follows. This time, momentum is the scout. It's telling us the breakout is imminent. So when I say this bull market is just beginning, that's not optimism. It's structure. The groundwork is literally built into the charts. But what's fascinating, and this is something most analysts completely miss, is how these technical structures line up perfectly with macro behavior. When you have sovereign wealth funds, central banks, and even private institutions buying gold while retail traders still chase tech stocks, you're witnessing a transfer of wealth in real time. The smart money always moves first. The charts are just the footprints they leave behind. And right now, those footprints are leading straight out of equities and into real assets. That's what this gold/S&P spread breakout really means. It's not about outperforming, it's about escaping. Capital is fleeing the synthetic world of paper wealth for the tangible world of finite assets. When that flow accelerates, it won't be subtle. It'll be a whoosh moment, a sound you can almost hear, and it won't stop at gold and silver. It'll ripple through commodities, energy, and even select equities that produce things you can touch. Now, people always ask me, Michael, where are we in the cycle? My answer, we're early, very early. Maybe the second inning of a 9-inning game. The next 1 or 2 years might look awesome, as I like to put it, because we're entering a new reality. But don't expect a straight line. Expect volatility. Expect sharp, gut-check pullbacks that scare off the weak hands. That's the cost of admission for a bull market this powerful. Think about silver in 1979. It doubled in weeks, then fell 30% in days, only to double again. These moves are not for the faint of heart, but they are the fingerprints of transformation. If you want smooth, predictable returns, buy treasury bills. If you want to participate in history, hold on to your medals. I've been doing this long enough to know when a market is whimpering and when it's roaring beneath the surface. This one's roaring. So when I look at this setup, the spreads, the momentum, the macro, everything points in the same direction. Acceleration. The kind of acceleration that takes gold from 2,500 to 4,000 before most investors even realize what's happening. The miners will multiply that, the silver will turbocharge it, and by the time the mainstream realizes it's happening, they'll call it a bubble, but by then it'll be far too late to catch. We're standing at the threshold of what may be the final act of fiat as we know it. That's why I tell people, don't get lost in the noise. Don't get shaken out by pullbacks. You can't have a multi-year bull market without corrections, but you can't have life-changing gains if you sell every time the market sneezes. The structure is sound. The momentum is aligned. The fundamentals are unshakable. You don't build this kind of base just to collapse. It's the starting gate to something historic.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.